we need to spend more time looking at how do we make the capital return process more efficient. If you look at who is making all the money from the transaction process in the market right now, it's the market-making community, really. But we're making it way too easy through our regulations and our policies for these guys to extract value when our investors are transacting. That stuff, we just need to tighten that up. If we can do that, it makes our market massively competitive, will attract IPOs.
Michael Seigne is a huge equity execution guy, and now you, and correct me, I'm sure I'm going to get this wrong, but you advise big companies on how to execute buybacks.
Yeah. So when a company's made a decision or they're thinking about making a decision to return capital via a buyback, I try and help make sure that they get it executed, in line with what they're expecting.
Now
there's a whole game in very, very big transactions, a lot of risk for the issuers, and so I try and make sure that they get a good outcome.
Let's talk about one that has intrigued everyone before we get to buybacks. Our friends here were very excited you were coming on, and so no pressure. He is also, by the way, coming on his birthday.
So you have to be nice to me.
28 again.
28
again. Michael is a special guest because I did ask him specifically for all you friends to look at whether or not you think we have a short squeeze happening in the markets right now, or do you sit in the camp that we're still going to have a correction sometime in October? What do you think?
I grew up in the world of momentum. Don't fight the tape. So the tape is pretty strong. I would not be trying to pick the top.
Yeah.
So
you can't ever call the top.
I think and there's so much things to be worried about in the market, and the market still seems to be strong. I wouldn't be intending to sort of fight it. Would be my world.
There we are. There you have it. AstraZeneca, moving on to that, because that has been really interesting recently, because AstraZeneca, as we know, has announced plans for a full US listing. However, it has cleverly diffused its fears of exiting the UK.
Yeah.
And it's said it will move away from ADRs for a direct listing of shares on the New York Stock Exchange, but it will continue to retain its UK listing and headquarters. So, first thoughts on this? It's good for the UK, right?
Well, insofar as they're retaining a primary listing in the UK, so they'll have dual listings. I'm not familiar particularly in any great detail with the company, but if you look at what's been happening in the UK over the course of the last 5-10 years, the number of listings we have as a net number has been declining rapidly. So I think to the end of this last year, December 2024, in the preceding 18 months, we lost 115 listings in the UK net on a total number which was around 1,100 at the start of that period, right? So more than 10%. It's pretty scary. So any more leaving just causes massive room for concern. They're not leaving, so that's got to be a good thing. Well done, London Stock Exchange. Well done, the market for retaining them, would be my sense.
But in the longer run, I guess, as you've clearly highlighted, I mean, I wouldn't say a big decrease. I would have gone with dismal. I guess the question here is, what does the UK have to do to turn this around? The IG, as you know, are part of this big push to save the UK stock market. Why investors should look to invest in UK companies, especially if they're listed here. In the US, it's different, right? I mean, I was there working in the summer last year in Washington, Michigan, and also Chicago. Everyone's got skin in the game because of the way their pension is structured. Should that be a call for structural change here?
Yeah, and there's massive amount of work being done. There's a firm called New Financial, a chap called William Wright, who I don't know well, but has done a tremendous amount of work on not just UK, but UK and Europe, looking at how do the pension systems work globally and what can we do in the UK and Europe to improve that. And one of the critical things is get people interested, get people invested, get people's 401k or ISA or whatever jurisdiction you're in, get them so that they care. But the bit that from my perspective, which I think is really interesting, and the difference between if you're listed in the UK versus if you're listed in the in the US, is how do people think about the returns that they get from their investments? And obviously you get price returns, but if we just, ignore the price return for a second and assume you're making the same investment. So just imagine if Tesco's was the same as Walmart in terms of, the scale of domestic penetration they have in their market and had roughly the same margins, all the growth opportunity, all those sorts of things. Are you better off owning a share in Tesco's or a share in Walmart? And then where are you going to get your returns from? You get your returns from dividends and or buybacks. That's how companies return capital to their shareholders. If you look in the US, if you're a shareholder in the US paying US taxes, if you receive a dividend, you pay a capital gains tax, circa 20%. If you're in the UK and you receive a dividend, you receive income tax. Depends on what your tax bracket is, but somewhere between 35 and 45%. Right? That's a massive difference. So UK companies are kind of going, okay, our shareholders want to see capital being returned, but it's actually more favorable to do it via a buyback from a tax perspective for the investors. And you've seen this huge trend in the US where buybacks have gone, relative to dividends. Now, total capital return, there's like 65% of notional capital return are via buybacks, and the 35% is via dividends. In the UK, we've gone the same way, but we're way later than the US. So 10 years ago, less than that, 8 years ago, the UK's, of the total capital return by the FTSE 100, about 10% was via buybacks and 90% via dividends.
Right.
This year, we're going to be 50-50 pretty much.
Interesting.
So there's been this huge shift.
Yeah.
But then you've got to worry about how do companies buy back shares in the UK versus in the US? And that's where the big problem is.
Yeah, because all this is telling me as I'm watching you speak is that, currently as the structure stands, if I were a big company thinking, should I list in London or the US, I would think, actually, I'll go to the US, bigger liquidity pool, ease of transferring, profits essentially back to shareholders. Yep. They get a bigger cut.
Yep.
Am I oversimplifying this?
Not really. I mean, people are incentivized by what's going to happen next. If you're, it depends on who you listen to, but let's imagine that companies in the UK trade at a multiple of whatever it is, 15 times earnings, and the US, they trade at 20 times earnings. If you're going to do an IPO, would you rather sell your shares at 20 times future earnings or 15? I mean, it's not a hard decision to make, right? You go for 20, right? So we need to solve that problem, which is...
We need to close that gap.
Yeah. So of course we're losing stuff to the US right now. I don't think we should. I think there's lots of things we can do which narrows that gap quickly.
Yeah, and just to illustrate this gap, take a look at the chart that I've just thrown up, FTSE lagging stock markets in the US and Europe. I'd imagine making an educated guess that this is a result or linked to what we've just been talking about. IPOs as well. I mean, in terms of IPOs, we keep seeing time and time again recently, many companies choosing to go across the pond to IPO. What's got to be done before we can fix this? You spend a lot of your time, Michael, advising, government.
I don't have advising, hassling them, annoying them. I don't think they sit there and they don't.
What's got to be done?
All of the focus is on two things at the moment. One is on trying to create more demand. So the pension world and this sort of stuff, talking to investors and trying to get people to invest. So there's lots of good work being done there. And then the other good work which is being done is sort of trying to make the listing process more simple, right? So the prospectus, make them easier, those sorts of things.
Less red tape.
Less. None of the work is being done, or very little of the work until very recently, is being done on the capital return side, right? Those things are capital investing side, right? The company's returning capital. If you look at the difference in magnitude, last year in the UK, I think we listed circa 8 companies. It was about £800 million of IPOs, new capital being formed. the capital return side was 130 billion pounds or 140 billion pounds, and roughly half of that was dividends and half of that was buybacks. We need to spend more time looking at how do we make the capital return process more efficient. And the giveaway in why this is really important is if you look at who is making all the money from the transaction process in the market right now, it's the market making community really. Like, so if you go look, it's the XTXs, the Jane Streets, the Virtus, the Citadel Securities, these sorts of guys. They do a fabulous job, but we're making it way too easy through our regulations and our policies for these guys to extract value when our investors are transacting and when our corporates are transacting on behalf of their investors. That stuff, we just need to tighten that up. If we can do that, makes our market massively competitive, will attract IPOs.
Fantastic questions from the floor as well, asking how did Brexit impact the status of the UK financial market, as it seems to have taken a hit since then. My goodness, B, we were just talking about this before coming in.
Yeah, I mean, I think it goes without saying, not a good thing.
No.
But the one positive of that is we're now in control of what we can do going forward. So if you look, the FCA, our UK regulator, has done a tremendous amount of work on trying to progress the competitiveness and the sort of situation within the UK independently from Europe. And we're moving much quicker. So there is tremendous potential. We've got to realize it now. That's the only good thing I can say.
I love how you're so optimistic.
Hey, we're in the markets. We have to be optimistic.
We are always
it's a full-time
optimistic.
job.
It is our full-time job. Speaking of optimistic, let's talk about General Motors versus Ford as well, because I asked you yesterday, give us something useful for our clients. How can we look at buybacks and read the signals and use that as a how can we use it in our investor edge?
Right, it's a really good question. And generally speaking, it's quite hard to get edge in these sorts of things. But so I was talking about General Motors as a great example. So if you go back to the start of that chart, which I think is sort of November 2023, at that time, General Motors had a market cap of about $40 billion. And they announced a share buyback executed in a very specific way through something called an ASR, Accelerated Share Repurchase Program. They announced a buyback there, which was worth $10 billion. So the really important bit from from an edge perspective is how big is the buyback announcement relative to the size of the company? This time it was 25% of market cap. So that's the first thing. Then the second thing is there any guarantee that it will get executed? And if there is a guarantee, that means that all of that $10 billion had to be spent in a defined time frame. And if you go back and have a look, they specified that it had to be complete by Q4 24. So they basically, the company and the brokers had about a year to complete that transaction. And then when you look at ASRs, our very peculiar version of the execution process of a buyback, they kind of set the market up for a short squeeze. And what you see in the difference between General Motors and Ford, which I don't know whether you can really compare the two companies, but you'll see about 100% price differential in absolute terms in that time period.
So I've used my measuring tool, friends, to give you a rough idea. This is a rough measurement. It's not completely, completely possible. It's a very rough measuring tool. That is up 134%. During that time. This is for GM. Let's have a look at Ford. Those of you that have never visited the Ford Rouge factory, I highly recommend you do it. It's in Michigan, in Detroit. Having a look at Ford here, and we're going to measure the difference there. And here is the measurement tool. And let's take it from there to there. So a huge difference. That's up 25%.
Yeah. So the point is that you could, if you knew what you were looking at, I'm not saying you could predict that total outcome, but you had a pretty good idea that there would be a lot more buying pressure and demand in General Motors or Ford. So I think that stuff is really interesting.
And also, watching you talk about General Motors, this is very interesting, very useful indeed. Thank you so much for sharing this. This is quite similar, and let's just outline for our friends as well what ASR stands for. It's
Accelerated share repurchase.
Share repurchase.
So what that means is there's really two ways of executing share buybacks in the market, as opposed to directly from, because all the company's trying to do is buy shares from its own shareholders, right? So if you had a company which has 100 shares and you own one of them, if the company announced a buyback, it's trying to buy back some of its shares from you and all the other shareholders. And the question is, do you want to sell or not? And if you don't sell, then the way it's beneficial to you is if you own one of 100, you own 1%. If they buy back 10 shares from other shareholders, the company now has 90 shares and you still own one. So your ownership went from 1% to 1.1%. That sort of idea. That's the big gig. The accelerated share repurchase process is when they announce the buyback, they also get given, they execute a whole bunch of that up front, or at least that's what the optics look like.
Right.
And then the game is where do those shares come from, and how do those people recover the short positions that they've basically got into with the company. That's where the trading game starts to kick in, and just understanding that is where there's some edge, I think.
Michael, is there a public list where I can find companies that are looking at accelerated share?
No, you have. Unfortunately, you have to see that in arrears. So there's a company last week, which I haven't done a lot of work on, but I think it's Marvel Technologies, and they announced a buyback program. And within the buyback program, there's $1 billion. So they announced a $5 billion buyback program. And within that, there's a $1 billion ASR. And the key there is the ASR has to be complete before the end of the year. So there's a compression of time. So the question then is, how big is 1 billion on the market cap of Marvel? And what will that mean? I think Marvel's got a market cap of around 70 or $75 billion, right? So it's not it's not like General Motors where it was 25%, but it starts to look interesting. So will there be a squeeze?
I like this. I like it when someone can give us signals of a short squeeze. Pelican asking, why do US companies announce buybacks periods 1 year plus, more than 1 year, and the CEO sells into those companies' highs?
I mean,
we talked about that conundrum, right? When you advise companies and you say, well, this is the inverse of the process, but it's very hard. I guess you have a very tough job explaining to those, obviously, CEOs, CFOs, all C-levels that are remunerated with shares, that actually to make those buybacks, you kind of want the shares to be low, not high, but they clearly want it high.
All shareholders always want the share price to be high. But I always try and get people to think, when I say get people, I mean the people in the company, the executives, to think about a buyback is literally just the exact inverse of a share issue. So imagine, we had this 100-share company and, you needed more money. So what you wanted to do was sell another 10 shares. So the company would become 110. The game is sell it at the highest possible price so that you get the most amount of money and you dilute your existing shareholders by the least amount, right? So that the game is obviously sell at the highest price. And obviously you receive money as a company from that process. A buyback is exactly the opposite. You have money, you've got excess capital, you want to return it to your shareholders. That process, you want to buy the shares at the lowest price. But you talk to an executive, they go, no. We always want our share price to be higher. Not when you're buying it. You want it to be low while you're buying it. You want it to be higher after you finish. You don't want to make it go higher when you're buying it, all else being equal. That process takes a little bit of, okay. And so when you're designing the transaction and the process, you've got to really understand, okay, why are you trying to do the buyback? What's the motivation behind it? And all those sorts of things. And then design the execution to suit. Lots of people in the US do try, and particularly in the US, it looks like they try and manipulate their own share price. Now, manipulation is a very strong word, so you need to have a lot of evidence for this sort of process to be accusational, which I'm not suggesting they are, but it optically looks like they're trying to do that. So then you look at, well, what's the insiders doing? So there's Marvel one. If you go look, you can look at what they call the 8Ks, which are our subset of SEC disclosures. What you'll see is details about the ASR. So how many shares have they received up front? It's about 80%. So it's a lot. And then if you keep on looking at all those 8Ks, you'll find that the major management have also bought shares. So to me, that's a very interesting combination signal. They're buying shares and the CEO, the insiders, are also buying. If you look at General Motors, Mary Barra and the CEO, the chair, was long a lot of shares already, and she exited as the share price went up, and it has continued to exit. Very, very different signals to me. Does that make sense?
Yeah. So all that sounds a bit like if I had to choose another company that had what looks like, and you might tell me it may be an ASR as well, is Vodafone.
So ASRs are a pretty uniquely American product.
Do we have something like that here?
Not really. We have similar sorts of products. In fact, if you go and look, if you were really, really tedious and boring like me and spend your time looking at regulatory filings and regulatory reports, the FCA just published in August a really fantastic, very, very detailed review of how do UK companies execute buybacks. And within that, they spend a lot of time on things, a specific set of buyback products called structured products. And the one thing that I think everybody should bear in mind with structured products, they can be fantastic things, but by and large, the people who make the money out of the structured products are the banks who sell the products. And they're very frequently associated with not such great things that happen in the market. So if you go back and look at the financial crash of 2007-8, that's
subprime.
If you go look at that, so there'll be things like CDOs and NBSs. They were structured products. If you go and look at some of the, so you and I were talking about 1MDB. If you go read that story, the Malaysian sovereign wealth fund, which sort of created and disappeared in that sort of 10-year phase, behind that, a whole bunch of structured products. So the people who buy structured products from the perspective of the bank, the ideal client is the client who doesn't really understand what they're doing. So it tends to be private wealth. Sorry, but that's the world. Banks will try and sell it to private wealth as these packaged investment products. Will guarantee you the return, or outcomes and all those sort of things. It tends to be the big sovereign wealthy community who are less experienced, in their sort of early phase when they're less experienced, like not the big ones that you'd know now, and it tends to be corporates. Do you know a guy called Matt Levine from your previous life, a Bloomberg journalist?
So it rings a bell.
So he writes a column called Money Stuff, and what's interesting about Matt, from my perspective, is he's an ex-banker, and within his banking world, he was the sales guy for structured products to corporates.
Interesting.
And prior to that, he was what the Americans would call a white shoe lawyer, a corporate lawyer. And when you read him, and he talks about things like Michael Saylor and strategy, microstrategy, and all what's going on in the capital markets, but to me, he always has a very interesting spin because he thinks from a legal perspective about a very usually complex financial structures from the perspective of how do they work. So I learn a lot from reading him. When he talks about buybacks, it gets really interesting.
Interesting. From just a very basic view, it used to be when someone said structured product, before they finish the product, you would always think expensive and what's under the bonnet.
Yep.
The other thing too is coming from an Asian perspective, this is before the GFC, before the whole, Lehman, before the subprime issue, debacle. I'd go into a bank on the high street and I was gobsmacked, Michael. I was gobsmacked to look at a simple mortgage product. Picked up a leaflet and then I read what it was offering. And actually I thought, you're selling this to Joe Bloggs on the street. This is actually an options structured product, underwritten by Credit Suisse. It says in very tiny writing at the bottom, and you are selling this to, Auntie Jane, Grandma, whoever, right?
Yeah. So this was my argument with the FCA with regards to these structured
all that
products.
gone now, of course. Right, after this is large, by and large, has disappeared now from the.
Okay, so go and look at the FCA's review. What they tell us about the FTSE 100 companies is that a little over 50% by value of all the share buybacks executed in the period they looked at, which was an 18-month period, a little over 50% by value are structured products. Now, what does that tell you? It tells you that these products are either sold incredibly cleverly, or the buyers don't actually know what they're buying, or a bit of both. And what my sort of frustration, the FCA did a fabulous job, but my frustration with the FCA and that process was the products aren't suitable for what the corporates need them to do. And this is shareholder money at the end of the game. What I was, sort of thought the FCA should have done is given a more severe warning to the corporates. But if you read the cover, it says nothing to see here. And what they actually did in the review, which was fantastic, was they kind of gave a caveat emptor, a buyer beware warning, saying, who are we? We're the regulator. And this is me talking. This is not what they said, but this is my interpretation, obviously. Who are we as the regulator to tell sophisticated corporates what financial products they should and shouldn't buy? But if we were looking at them, we would pay a lot of attention because there's a whole bunch of risks you might not know. And there's really weird risks. So one of the risks is the execution buyback against which the performance of the products is guaranteed is not a benchmark which is remotely sensible and not the right way to calculate the average price and all those. So the FCA actually they spec that out and go, they give examples of if the shares trade on these sort of things, here's what the price would be, here's the price you get, suggesting I wouldn't do that if I was you, but they don't say it. So they just give a warning. And so what the FCA have done, in my opinion, is they've shifted the responsibility to the corporate and the governance process than the investors, which is sensible on one level, but frustrating because then it means that there's a whole nother world that needs to get educated and really understand the products before they can see the potential damage they're doing. And I have examples where normal execution, right? Your clients will know this, right? It's pretty cheap these days, right? The sort of going rate for commission for a very large investor, is somewhere between 2 and 10 basis points, right? 100th, a base point is 100th of 1%, right? So it's pretty low. I've got examples where clients being corporates, like last year paid 4%, 2 years ago paid 8.5% to buy shares. It should be pretty cheap.
Yeah. It's the equivalent of going to a restaurant saying I want a coffee, then going to a restaurant and saying I'm going to host a wedding. Can I get a coffee? And you see this sudden premium being buried in. It's a good one. That builder's intake of breath, right? We got questions from the floor. Neil, who's away from the numbers. Hello, Neil. As a long-term Vodafone shareholder, I'm struggling to see the benefit of share buybacks. What's the purpose of holding these shares in Treasury?
It's a really good question. So the advantage to Vodafone, if they hold shares, is if the share price goes up a lot, they can just sell them without having to issue. So the shareholders won't get diluted if they sell. But more often than not, what you'll find is they'll hold them in Treasury for a period of time, and then they'll cancel them. And there's regulation in the UK as to how long you can hold them and those sorts of things. So it depends on what they're going to do. More often than not, when there's large buybacks, which are structural, is one of the structural ways in which the company is trying to return capital to shareholders instead of or alongside dividends. Normally what you'll see is they cancel them, or rather cheekily, they may provide them to their internal management as a compensation.
Hello!
So that's why
a few more to you.
You need to pay attention to the net number of shares out there, right? Or how much are they issuing to internal management? Or if they don't need to issue to internal management, if they've already bought them in Treasury, they just reallocate them.
Right, I've got one more question. Can you touch on US company buyback windows? It will close soon on earnings.
This is a huge, big misunderstanding in the market. If you look at how companies execute buybacks, typically they'll contract with a broker. And the purpose of the contracting with a broker is so that the broker can execute the buyback throughout the open and closed windows. Now, it's hard to see this, but ASRs, for example, are a classic example of this, right? It doesn't matter whether the company's in an open or closed period. Once they enter the contract, what the company does is they basically outsource the trading decisions to the broker, so they can trade all the way through. So if you actually look at, rather than the windows, if you look at the behavior of brokers who execute buybacks on behalf of other people, you'll see that the peak purchasing is actually when the share prices go down, rather than where we are in the reporting window. So actually, it's really badly understood by the market. But I would tend to not pay that much attention to that. Oh, we're going into the window. I don't think it makes a ton of difference.
So those of us not in the market, what is the earliest sign? Where can you find the earliest signal that a company's about to announce a share buyback?
Yeah, I mean,
what's the hack, Michael?
Yeah, I don't have the hack. What you need to figure out is are they cash flow? Again, I'm an execution guy. Yeah, I'm an execution guy, so totally ignore me what I say here. But are they cash flow positive? Have they got a decent, strong balance sheet? And then, what are they doing? Are they investing in growing, their R&D and in growing products and all those sorts of things? Or are they signaling that they're going to return capital? If they're signaling they're going to return capital, they've got two choices: either increase dividends. Management typically hates doing that, because when they increase dividends, it's very hard to reduce a dividend. They prefer a buyback because it's perceived to give them more flexibility. So, they might commit, 100 million pounds to a buyback. Next year, they're not really obligated to do the same thing. Whereas if they commit 100 million pounds to a dividend, they're kind of obligated at a minimum to do the same thing, right? So management prefer, and investment banks prefer advising management to do more buybacks and dividends. Why? Because investment banks make a fee.
Ka-ching!
Precisely, right? So the incentive for the bank is, hey, most investment banks hate companies doing buybacks. Why? Because they'd much rather the company took that money and bought another company, right? M&A, because it's got a higher margin.
Nice fees.
But if they're going to do a buyback, they would rather it was a structured buyback rather than an agency buyback, because the potential to execute it and have a higher margin is much higher in a structured product than it is in a regular vanilla agency transaction, right? So that's why I think you see behind the scenes, the people are just responding to their incentive. They'll sell the product with the highest margin. Like, no surprise.
Fabulous.
They're just humans.
Yeah. Thank you very much.
Well, thank you very much, guys. Hope this was useful.
Very insightful. If you like that, hit the like and subscribe button. And you've got more questions, put them to me or Michael or Rich on ask@ig.com.